Hi there, it's Michael Beresford here from OpenCorp for the Q3 of the financial year 2018 market update. For those of you that have seen our two previous market updates, you will have noticed that we spent a lot of time talking about the state of the states in terms of where we see the four main capital cities in the cycle and some related data around those figures to support our position on the forecasts and assessment on where the key capital city markets are at. Today, with this update, I'm going to take a little bit of a different approach. We'll still cover the state of the states and some of the key data, but I think it's really timely to take a snapshot given some of the movements in the market that we've seen over the last 12 months and really just give a bit of a sanity check or a reality check on where we're sitting around a lot of those key topics. So hopefully you get some value out of the next 10 minutes or so. Since our last update, which was about 3 months ago, obviously we're looking at the quarter data over the Christmas New Year break. So the main thing that we have seen in the market is that sales volumes have slowed. That's to be expected, obviously, with Christmas and so forth. But the actual sales volumes itself are down 7.3% over the last 12 months. Okay, so why is that relevant? Because obviously we've continued to see increases in property prices, but a slowing in sales volumes. So if we go back 12 months, really the major impact that we saw on March 20th, I remember it well, in 2017 was when APRA inflicted the most severe, I guess, of the tightening criteria across the major banks. We've said this in multiple videos, but if this is the first time that you're watching, a really quick recap. APRA had two main goals. The first was to reduce the percentage of any bank's loan book of interest-only loans to 30%, and to also reduce down to 10% per annum the growth year on year of interest-only loans. Okay, now that's been in play for pretty much 12 months to the week. So because those lending criteria have got tighter, it's meant that fewer borrowers have the borrowing capacity or the ability to be able to buy the properties that they want. So in context, a 7.3% reduction I think is still a pretty good result given how severe those tightening criteria were. I've been in and around property for close on 20 years, and I haven't seen the servicing criteria as tight as what they've been in the last 12 months in my nearly 20 years in the business. So that gives us some added confidence, obviously, around the stringency of the way that banks are assessing lending and people's ability to be able to repay the debt that they're borrowing. But all in all, a 7.3% reduction is not a bad result. In more of a positive for investors out there, what we have seen is the indications and the very early signs of some of the relaxations, I guess, around those lending criteria. The first is that we've seen CBA, Commonwealth Bank of Australia, recently come back into the marketplace with a 90% interest-only product for investors. And we've also seen that NAB have reduced their investment variable rate by about 20 basis points as well. So very early signs, but we're starting to see that relaxation. We have also seen increases in sales activity in more affordable markets. So obviously, with these lending changes that have happened, the more debt you're looking to take on, in addition to the existing debt that you have, the harder it is to service. So it stands to reason that sales volumes in the more expensive locations, typically Sydney and Melbourne, will have contributed the majority of that reduction. So people will look to affordable markets. That's obviously part of the opportunity here that we're looking at. It's not all doom and gloom, and we've seen sales volumes in more affordable markets increase. Interestingly, Wayne Byers, who is the head of APRA, essentially, has recently, in recent weeks, come out and made a couple of announcements around those initial APRA criteria. The first is that they are going to be quite steadfast in terms of keeping the banks to that 30% cap of their loan book being interest-only loans. But on the flip side, while they haven't announced a specific date that it will take effect, they do believe that that 10% year-on-year growth of interest-only loans may be relaxed in the future, given that the reduction has been so steep, and that growth is trending more like 5% year-on-year since the changes were announced. Okay, so there's a quick snapshot, I guess, on the key major change that we've seen in the market at this point. If we're looking at the state of the states, I really want to stick to two key topics. Okay, the purpose of this market update is not to bombard you with data, but ideally to be an impartial and reliable source that you can come to be able to get a snapshot in terms of where we see the markets at. So those two things that I want to focus on are jobs and affordability, and excuse me, and also median household incomes. So if we're looking at jobs and affordability, while we've seen population growth in Australia grow pretty consistently year on year over the last 6 to 7 years at around 1.6 to 1.7% per annum, what that does is it adds a total population growth for the country at around about 400,000 people as a round number. Now, jobs were really the standout development in the last 12 months in Australia, with just over 383,000 jobs created. Now, what's really interesting is the vast majority of those, close to 90% in fact, have been jobs created in the three main capital cities. Okay, so according to Tim Lawless he's the head of research for CoreLogic, those job figures are around 113,000 raw job figures, 113,000 in Brisbane, 111,000 in Sydney, and Melbourne down to 94,000 as well. Now, interestingly, going back about 4 months, Melbourne was on top of that list. So obviously there have just been some adjustments there, taking into account the last quarter's data. But no doubt, you know, with such a significant percentage of that job creation happening in the three main capital cities, hence why we expect those property markets to be stable ongoing, because it is just supply and demand that drives that price growth and demand for housing. If people are in jobs and secure in their jobs more so, then obviously their consumer confidence is up, and they look to purchase housing. What is particularly relevant, however, is around affordability. So you would have, if you've seen the last updates, we would have talked about the fact that we wouldn't be looking in Sydney because it's definitely towards the top of the cycle, has seen double-digit growth for several years on end. Melbourne, limited opportunities in Melbourne. Brisbane is a big focus area for us, and Perth is more of a medium-term play in terms of the capital growth opportunity there. To put that into some context and to support that with some numbers for you, if we look at the percentage of the gross household median income required to cover a loan of an 80% loan-to-value ratio in each of the three main capitals, in Sydney, it's 48.4% of that gross annual household income. Okay. In Melbourne, it's 39.9%, and in Brisbane, it's only 31.7%. Okay, so probably not a lot of surprise there in terms of the fact that Sydney, then Melbourne, then Brisbane is kind of how it scales in terms of relative affordability. But it does just talk to, and I guess support, you know, the findings that we were talking about with regards to the forecasts for how we saw the markets unfolding in 2018 in our last market update for you. What is particularly relevant is affordability is one component of that, but it's also what the median household incomes are relative to those different locations, because essentially the more you've got in your pocket, you know, then the more that can substantiate house price growth into the future. Okay, everyone's going to be different in terms of what they're comfortable in spending, but that's the nature of one of those underlying criteria around price growth moving forward. So while the Sydney median house price is 102% above Brisbane's median house price today, it's interesting to note that the median household income in Sydney is only 12.9% above Brisbane's. Okay, so there's a massive discrepancy there. essentially, you know, Brisbane has a lot of catching up to do, and surplus income from people living in Brisbane to be able to support that price growth moving forward. Okay, so we do see Brisbane being a very strong market over the next 3 to 5 years. Where it gets really interesting though is Melbourne and Brisbane. So while the Melbourne median house price is 57% higher than Brisbane's median today, the median household income in Melbourne at last check is actually 0.7% below the median household income in Brisbane. Okay, so that just gives some context around the fact that while the Sydney and the Melbourne markets have been on a strong growth curve, for those of you that have property or are looking to acquire property in Brisbane from an investment perspective, you know, the market has taken a little bit longer than what we thought to start that growth curve, but no doubt the potential is definitely there moving forward. So that's where I wanted to leave the state of the states. If we look specifically at the fundamentals, there are 3 key takeaways that I want you to take away from this in terms of keeping a rational view on the property market in Australia. The first is that markets cycle. Okay, I've spent the last 10 minutes talking about it. Different capital city markets move at different times. There is not one property market in Australia. You know, there are capital cities, there are regional markets, there are mining towns, there are all these different markets, but even within one type of market, being the capital city markets, they don't all move together. You know, they cycle at different times, and what is really important to remember is don't get caught up in the emotion of trying to make some money quickly by plunging into an expensive market that's already seen substantial growth. Invest rationally, be a smart investor, and invest where the potential to maximize that growth outcome exists over the years to come. That'll obviously allow you to create that equity and then duplicate that process and build your portfolio across several capital cities in the process. Okay. If we look at the second fundamental I want to leave you with, it's nothing new. I'm going to reinforce it. Property markets are driven by supply and demand. Okay, so obviously I've mentioned the jobs data. The majority of them are going to the key capital cities. That will underpin the stability of those markets in our view. And while the government has a commitment to skilled migration, and about 60% of Australia's population growth last year was from net overseas migration, then that obviously just bodes well for the stability of the housing market. That leads into one of my big passions, as you know, guys, if you've been watching our videos for some time, and that's trying to help Australians navigate the property and the finance industry through the media in terms of what we talk about with white noise. Okay, so for those of you that haven't heard the term white noise before, what we're referring to there is that the media love to take you on an emotional journey of boom and bust, to get you vested into looking at what the update is the next day. And that can be really detrimental to helping you take a long-term and stable view of what you want your investment portfolio to achieve for you. The big one, you may have heard of him previously, and he's kind of come into prominence again in the last 3 to 4 weeks. His name's Harry Dent. He's a US demographer. I've never met Harry, but I'd love to have a few minutes with him. He's notorious for making these outlandish statements and forecasts around the Australian property market. And funnily enough, it tends to coincide with when he's got a new book to launch, which is no different to this time around. He's found himself back in Australia, and I guess what I want to leave you with, is just some rational information to help you be able to resist the temptation to buy into Harry's sensationalist type approach. Okay, he's a big advocate that we're in a housing bubble in Australia, or definitely in the key capital cities. Okay, to the point where in 2014 he predicted that there was going to be a 55% drop, or there could be a 55% drop in house prices in Sydney. Now, funnily enough, he also predicted that in 2011 and 2012, as well as numerous times during the decade from 2000 to 2010. So when we consider that in that same period of time, the Sydney median house price has grown about 75%, then there's about 130% difference there in terms of what's actually happened versus those forecasts. Now, unfortunately, we hear stories of people listening to this kind of commentary and deciding to sell property as a result and buying into the fear-mongering. Those that have done that have obviously missed out on a massive growth opportunity to be able to build their asset base, set them up financially for later in life. So it is something that we're passionate about. The other thing that I guess I want to mention is just to put some context around what I don't think Harry understands very well. He's a US demographer, and in essence, there are two key fundamentals that differ between the US and Australia when it comes to the property market. Okay, and as you know from our videos and from this market update so far, there are some pretty consistent themes here that drive the market. One are the lending practices that exist with banks, and the second is around supply and demand underpinning the stability of housing markets. And it's no surprise that these are the two things that vary significantly between America and Australia. The first is that basically the American lending system was the result of, or led to the result of the subprime crisis. Ninja loans were being offered. Ninja stands for no income, no job or assets. So basically they were happy to lend money to people that didn't have any security to back up that loan. We're always going to struggle to repay it, but they were able to package that debt as AAA credit rated packages that investment banks like Lehman Brothers invested in. And the fact that the lending system in America has a non-recourse policy. So basically, if you don't want to own your house anymore and you don't meet the repayments, then you can literally just drop the keys on the desk of the bank manager, and then the bank then obviously owns the house. Now, that's obviously very different to how it works in Australia. Anyone that's got a mortgage knows the level of stringency and diligence that the bank does on you, and the way that you are responsible for meeting your financial obligations. So what we saw there with the subprime crisis was obviously with the job losses, the banks taking on a lot of these houses that they'd repossessed, obviously due to supply and demand, not a lot of demand, a massive oversupply of properties that they had, and the values fell dramatically as a result. So that's how the lending system is different. The final one really comes to supply and demand. I mentioned this to a few clients and friends about a month ago, and this piece of data has really sparked their interest. So I thought I'd share it with you and finish the market update with it today. While the US has a population of about 10 times the Australian population, it's geographically, it's laid out very, very differently. Okay, and the question I've got for you to think about is if you ranked all of the major capital cities in America based on population from largest to smallest, and then we inserted Sydney and Melbourne into that list based on population, where would Sydney and Melbourne sit? Okay, so just think about that for a second. Typically, most of the answers that I get are somewhere around 30 to 50 on that list. Interestingly, Sydney would sit at number 2 and Melbourne would sit at number 3. Okay, so just take stock of that. A country that has 10 times the population of Australia's would actually have our two main capital cities in their 3 most populous capital cities. So New York's at about 8.8 million, Sydney's at 5 million, Melbourne about 4.5 million, LA is currently number 2 on the American list at around 3.8 million. Okay, so the takeaway point is when we're listening to commentators that come from America, they're applying an American lens to the Australian market, and there are some really fundamental differences there. So Harry, if you're watching, hopefully you've learned that and understand that difference. Take a long-term view with property, guys. We empower you to do that, and know that the supply and demand equation, especially in the capital cities in markets in Australia, provide us a pretty robust investment. Hopefully you've enjoyed the Q3 market update recap. We'll look forward to seeing you in 3 months from now. Bye for now.